You may be wondering how mortgage rates are decided. Obviously, you want to make sure you get the best possible rate. But how are mortgage rates determined, and what can you do to make sure you have a good rate? Hello, this is Melissa Arntzen with Element Mortgage, and this is Mentoring with Melissa. In this video, we will share how mortgage rates work. There are several outside factors that affect how mortgage rates are determined today, but you can only control one aspect of your mortgage rate, and that is your personal factors. Lenders look at your qualifying factors to determine your risk level. The better your qualifying factor, the better the interest rates they'll offer. Mortgage rates begin with the current market rates, so you may wonder how the market affects interest rates. Mortgage rates are affected by the overall economy. When the economic outlook is good, rates tend to increase. And the rates fall when the economic outlook isn't so good. Mortgage rates are determined by many elements, including the inflation rate, the pace of job creation, and whether the economy is growing or shrinking. The Federal Reserve doesn't set mortgage rates, but it does affect mortgage rates indirectly. The Fed controls short-term interest rates by increasing them or decreasing them based on the state of the economy. While mortgage rates aren't directly tied to the Fed rate, when the Fed rate changes, the prime rate for mortgages usually follows suit shortly afterwards. The Federal Reserve controls short-term interest rates by controlling the money supply. When the economy is struggling, as it did in the case of COVID-19, the Feds lowered the rates. These are not the rates given to consumers, but the rates at which banks can borrow money to lend to consumers. When the Feds decide they need to tighten up the money supply, they raise the Fed fund rate. While this doesn't directly increase mortgage rates, eventually banks and lenders must follow suit to keep up with the cost of money to borrow money from the Feds. Which personal factors affect your mortgage rates? You certainly cannot control the economic factors of mortgage rates, but you most definitely can control your own personal factors. Let's dive into what you can do to get the best mortgage rate possible, beginning with your credit score. A high credit score means you're less of a risk to lenders. A high credit score shows that you pay your bills on time and don't overextend your credit. When lenders pull your credit, they see that you're a responsible borrower and a low risk of default. This lends lenders to give you better interest rates because you're less of a risk. When you have a lower credit score, lenders often change the interest rate significantly because you're a higher risk of default for the mortgage that you're getting. A low credit score indicates that you may not pay your bills on time and that you may be overextending yourself. The credit score you need depends on the loan program you're using. If you want a conventional loan, you'll need to have at least a 620 credit score. But if you're choosing an FHA or VA financing, you'll need a 580 plus credit score for most lenders. Taking steps to check and improve your credit will put you in a better position to get a lower rate from your lender. The next factor you can control is your down payment. Lenders want to know that you're invested in the home through a down payment. The more money that you have invested in the home, the less likely you are to default. If you put down less than 20% on the home, your mortgage rate may increase and you'll need to pay mortgage insurance. There are different types of mortgage insurance depending on the type of the loan program. Some can be canceled and some cannot. The next thing that will affect your interest rate is your loan to value ratio. Your loan to value, or LTV ratio, compares the amount of your loan you're hoping to borrow against the appraised value of the property you want to buy. The less money you put down on the home, the higher the LTV becomes, which is a higher risk to the lender. When you put down little money on your own into the home, you have less incentive to keep paying the mortgage when times get tough. If you have your own money invested, though, you're more likely to do what's necessary to keep good on the debt. Another factor lenders will look at is when raising your risk is how you intend to occupy the house. Lenders care about whether your home is your primary residence, which means that you'll be living there, or if it's a second home like a vacation property, and finally if the home is an investment property that you'll be renting out to others. Interest rates are usually lowest on primary residence because it's where you'll live, where you're more likely to make your payments on time because you don't want to lose your home. If you have a second home or investment property and you have financial issues, you're more likely to default on the mortgage, putting the lender at risk. Most lenders will charge a higher mortgage rate to make up for that risk. The bottom line is that both market and personal factors affect your mortgage rates. While you can't do anything about market conditions, you can control your personal factors. Improving your credit score and saving for a larger down payment are two of the best ways to improve your chances of securing the best mortgage rate for you. Always be sure to work with a licensed mortgage professional and get your questions answered. Thanks for watching. This is Melissa with Element Mortgage. This is Mentoring with Melissa. And if you know somebody who is looking to buy a home or refinance or just get your questions answered, please contact me at 916-316-0672. I look forward to helping you get into the house of your dreams.